It starts with a headline. Markets plummet. Investors panic. Social media spirals into fear. Numbers fall, confidence shakes, and the collective emotion of the world seems to shift overnight. If you've ever watched your investments drop in value, you know the feeling. The tightness in your chest. The urge to act fast. The looming question, should I sell everything before it gets worse? But in these exact moments, when it seems like everything is falling apart, the most powerful financial transformations are possible. The market crashing isn't a sign to run. It's a test of your clarity, alignment, and long-term perspective. Let's talk about how to meet that moment, not with fear, but with grounded power. Why the market crashes, and why it's normal. Before you even respond, it helps to understand what's actually happening. Markets crash for all sorts of reasons: economic downturns, global events, rising interest rates, political instability, or even mass panic. But these crashes aren't anomalies, they are part of the natural rhythm of financial systems. Every ecosystem breathes. It expands and contracts. The financial market is no different. In fact, if you look at the historical data of the stock market, every major crash, no matter how dramatic, has been followed by eventual recovery, and often, massive growth. The Great Depression was followed by the greatest innovation era in US history. The 2008 crash birthed a wave of new financial tools, tech, and investment models. The COVID-19 crash was followed by one of the fastest recoveries in market history. So when a crash happens, don't think the end. Think the clearing. A necessary reset. A purge of speculative excess. A new beginning. The psychology of a market crash. The biggest mistake people make when the market crashes is this: they let emotion replace strategy. Markets are driven by two dominant emotions, fear and greed. During a crash, fear takes the wheel. People sell at losses. They move to cash. They convince themselves that waiting it out on the sidelines is safer. But fear rarely makes good financial decisions. When you're in a fear state, the brain wants certainty, safety. And the market offers none of that. It fluctuates wildly. It demands patience. It tests your beliefs. That's why reactivity is the true danger, not the market itself. The wisest investors don't operate from the emotional surface. They go deeper. They observe, evaluate, and act from a place of calm, grounded strategy. Step 1: Zoom out. The first thing to do when the market crashes? Zoom out. Look at the long-term chart. Not just the past month. Look at 10, 20, or 30 years. What do you see? You'll see that every dip, every crisis, every moment of panic is eventually a blip. If you had invested right before the 2008 crash and held on, you'd still have grown your wealth significantly over a decade. If you had bought at the market's peak before COVID-19, you would have recovered in less than a year. Time is the most powerful ally in wealth building. Crashes only hurt if you panic and sell. Ask yourself, are you investing for the next 6 months, or the next 6 years? Are you building generational wealth, or chasing quick wins? Zooming out recalibrates your vision. It grounds you in perspective. Step 2: Check your inner alignment. The market's instability can reveal something deeper, your own internal instability. Are you only comfortable when everything is going up? Or have you built your financial foundation to withstand storms? This is where emotional and energetic alignment with money becomes essential. When you trust your strategy, your vision, and your values, external chaos doesn't shake your core. Take a moment of stillness. Ask yourself, do I truly understand what I've invested in? Did I make this decision from intuition, research, and alignment, or from hype? Is my money placed in assets that reflect my values and long-term vision? If the answer is yes, then the crash isn't a crisis, it's a deepening of trust. Step 3: Reframe the crash as an opportunity. Most people see a crash as a danger zone. But seasoned investors see something else, a rare buying opportunity. When the market is crashing, prices fall, not just of volatile stocks, but often of quality assets, too. Businesses with real value, strong fundamentals, and long-term potential can be bought at a discount. This doesn't mean you should recklessly throw money into falling markets. It means, you remain observant, you look for value, not hype. You stick to your investment philosophy while being open to new entry points. Some of the greatest fortunes in history were built by those who bought when everyone else was selling. Not because they were reckless, but because they were calm, strategic, and prepared. In a crash, cash becomes power. Clarity becomes wealth. Step 4, resist the need to do something. In moments of crisis, the instinct is to act. But sometimes, doing nothing is the most powerful move. If your portfolio was built with purpose, diversified, balanced, long-term focused, then your job is to stay the course. Selling at a loss locks in the loss. Reacting emotionally creates unnecessary mistakes. Instead, go back to your plan. Are you investing regularly through dollar cost averaging? Are your emergency funds intact? Is your financial foundation stable? If so, trust the system you've built. Wealth grows through resilience, not overreaction. Step 5, fortify your financial ecosystem. A crash is a perfect time to reassess your entire financial system. Is your portfolio diversified across industries, geographies, and asset types? Do you have exposure to more stable investments like dividend stocks, bonds, or long-term index funds? Are you using this downturn as a mirror to see where you might have overreached? It's not about perfection. It's about reflection and refinement. Crashes often highlight where you are overleveraged or following trends rather than truth. Use that awareness to build a more solid structure moving forward. What to avoid during a market crash? Just as there are wise steps to take, there are also traps to avoid. Don't check your portfolio obsessively. This feeds anxiety and creates impulsive energy. Don't take financial advice from panic-driven sources. Hype and fear are loud during a crash. Stick with trusted, long-term voices. Don't isolate. Crashes can trigger deep emotions, shame, fear, scarcity. Talk with others who are financially grounded. Perspective is stabilizing. Don't abandon your principles. If you are building wealth ethically and intentionally before the crash, hold to that. Crises are when your values matter most. The gift hidden in every crash. It's easy to fear the fall. But every crash is also a clearing. It clears out noise. Hype? Shallow speculation. It resets the system and shows us who is building on real value. And in the stillness that follows panic, something sacred happens. You meet yourself again. You get to reconnect with your financial purpose, deepen your commitment to ethical wealth, realign your strategy with greater clarity. Crashes don't just reveal financial truths, they reveal personal ones. They show you your resilience, your beliefs, your growth. They call you back to what actually matters. Final thoughts: this is the wealth moment. You don't become wealthy just by riding bull markets. You become wealthy by staying grounded during crashes. This is the wealth moment, not because everything feels easy, but because how you respond now will shape your financial future more than any good economy ever could. So stay calm. Stay clear. Stay curious. You were not meant to run from the crash. You were meant to rise through it, with clarity, confidence, and deep inner wealth. Thank you for being here. If this message supported you, don't forget to like, share, and subscribe. Together, we're building a world of ethical, intentional, and empowered wealth, no matter the market conditions. See you next time.